Welcome back to the second half of accounting class on February 12th. A couple more announcements. Wanted to make sure you remember that class this coming week is not on Monday but on Tuesday. I mentioned that in the first half, but someone always forgets. And the second thing is the final exam. And the official word on the final exam for the live students is that it's Monday of exam week, and that's 4/30, April 30th. Regular class time from 6:30 to 9:20. So the final exam is during our regular class time on Monday, April 30th. Now for tape delay, the official exam time is Tuesday, May 8th. So Tuesday the 8th from 3 to 6 is the official delay. And again, just so you can put it on your calendar, depending on whether you're live or taped away.
Is it in this classroom?
It is probably in this classroom. I'm giving you 80% on that one. But technically they switch them around, maybe. But for this class, since it's a distance class, it's usually here. Although it would not be televised. So we could, in theory, have it anywhere, so it wouldn't really matter. So that's why I say I'm pretty sure it'll be here, but I'm not 100% sure. Any questions before we start on anything we're doing so far? Okay. So we want to go back to present values and talk a little more about present values before we talk a little bit about ratios. Next topic is compounding. Now, suppose that we have a situation where we are earning 10% over 2 periods. We start out with $1,000. We're in 10% for 2 periods, and suppose it's 10% compounded annually. What do we have at the end? And we already figured that out, right? That's what we started with in this particular PV class, and the answer is $1,210. That's my recollection. Is that right? Now, this assumed the compounding was what? Was annual. Suppose we have semi-annual compounding. Then what would we have at the end? Well, first of all, if we have semi-annual compounding, what does that mean? It means we're compounding at the end of 6 months. So instead of having basically 1 compound, we are going to have 2 compounds, or call it 4 in this case, right? So 1, 2, 3, 4 periods. And if the interest rate is 10% for the year, it's how much per 6-month period? 5%. So now the future calculation would be the future value, and I'm looking for the future value, right? That's the amount I'm looking for, of $1,000 for 4 periods at 5% per period. Now, before you do that, is this amount going to be less than or greater than 1210? It's going to be greater than 1210. Why? Because we're earning interest on interest sooner, right? So if we look at 4 periods, 5%, and again, I'm going to do it using a calculator. $1,000, oops. $1,000 is the present value, 5 is the interest rate, 4 is the period. Future value is 121551. So we get an additional $5.51 over a 2-year period if the compounding is semi-annual instead of annual. Does that make sense to everybody? Okay. So using that notion, let's do another example that involves compounding. Let's assume you're going to buy a house. And you're going to pay $120,000 for the house. It's a small house. And you have a $20,000 amount in cash, which you're going to use as a down payment. And the interest rate is 12%. What's the question? What's my first question? How much do you have to pay? Now, how often do you pay on mortgages? Monthly. And what's its interest rate? Yearly. Right? So let's draw a picture. The picture is that we're going to make some payment every period, and that's the question, from period 1 up to period when? How long are mortgages? Usually 30 years. Therefore, how many months are there? 360. So from period 1 to period 360 is the number of periods. Now, what's the interest rate? If it's 12% per year, then the interest rate is what per month? 1% per month. And how much are we going to borrow? $100,000 because we're putting the deposit down at 20. So that means we're just going to borrow less, right? Now, so what are we looking for? How much is the payment? And so in this case, the present value of an annuity, and that's the question, right? What's the annuity? Right here. For 360 periods at 1%, all that's equal to what? To the amount we're borrowing today, which is $100,000. Does that make sense so far? Now, the way we would solve this is what? We know that some number A, that's the annuity itself, times the number from the table at 360 periods and 1%. Now the problem is that our tables don't have that, right? But if we did have it, we could look that up. And that's equal to $100,000. So in order to calculate A then is equal to the $100,000 divided by the number from the table. Does that make sense to everybody? Now, that is why I suggest you use either a handheld calculator or learn to use Excel or some spreadsheet to get this answer. That's not the answer, incidentally. And the reason is because it's never ever the case in real life that you can use the tables. Because the numbers in real life are, interest rates are 7 3/4, 6 5/8, things like that. And it's just virtually impossible to use a table to do present values. So learn now, either get a handheld calculator and or both. And my recommendation is both. Learn how to use either a PDA or a handheld calculator and learn how to use Excel. Now, in this case, the answer is 1,029, if you were to look it up. Now, let's take this example a little bit further. Let's ask a few more questions. If you would take me and move me up to the top here, please. Hello, guys in the back. I'd like to use this area of the pad right here. Oh, that's just as good. Okay. So given this example, and you can put me in the top right. You can just put me over what we've already done. Let's extend this. And the first thing we'll extend to is in the second interest payment. The question is, how much is interest? So second payment we make on this mortgage right here, how much of that payment is interest, and how much of that payment reduces the amount that we owe the bank? Does that make sense to everybody? Question number 2. Question number 2 is, suppose we hold this mortgage for 30 years. How much interest do we pay over the life of the mortgage? So, I'll put life in there. So, if we hold this mortgage for 30 years, how much interest do we pay in order to borrow $100,000 today? Number 3. Suppose we pay this mortgage off at the end of period 20. So it's a 30-year mortgage at the end of 20 years, right? How much do we owe the bank at the end of 20 years on this mortgage? How much do we owe the bank? Does that make sense, everybody? Let's start with the first one. The second interest payment. How much is interest? How much reduces the amount that we owe the bank? Does that make sense? Okay, who knows how to do that? My suggestion for doing this is to create what's called an amortization table. You're going to amortize this loan. And in this case, amortize means you're going to take it from $100,000 balance down to a zero balance at the end of 30 years. That's what amortization means. Now, the amortization table looks like this. The payment, we put in the first column. Now, part of that payment is going to be the amount of interest that we owe the bank. Part of that payment is going to reduce the outstanding balance of the loan, or the principal. And the last column will be for the principal itself. Now, the original principal, how much do we borrow again? $100,000. So the original principal amount is $100,000. In period 1, what was the payment again? 1029. So the question then becomes, of the payment, 1029, how much of that is interest? How much of that reduces the amount that we owe the bank? Reduces the amount of the principal. And then what do we owe at the end of the first period? Well, here's the question. What interest rate are we paying for that month? 1%. We're paying 1% of how much? 1% of the outstanding balance, right? So 1% of the outstanding balance, 1% of 100,000 is $1,000. And therefore the amount that we reduce the outstanding balance is $29. Therefore at the end of period 1, if we were going to pay off our mortgage, how much do we owe the bank? $99,971. But that's not the question, is it? The question is, for the second interest payment, the second payment you make to the bank, how much is interest? Well, what's the payment again? $1,029. It's an annuity, the same payment every period. In this case, it's a payment that we're making to the bank. Although sometimes you hear about retirees getting an annuity, right? And that would be a payment they are receiving from, say, the pension fund or something like that. But in any case, 1029 is the amount of the payment. How much is interest? You pay interest at 1% of the outstanding balance, which is now $99971. So this would be $999.71. And the principal amount would be $29.29, right? So at the end of the second period, it would be 999, 30 from that would be 41.71. Does that make sense, everybody? Now, suppose you bought this house on January 1st. What kind of a tax deduction would you get at the end of the first year? In other words, if you buy a house, you get a tax deduction for the amount of interest that you pay on your mortgage. How would you calculate your tax deduction for owning this house?
The interest column.
You'd go from period 1 down to period 12, right, January through December, and then you would add up that portion of the payment that is interest and interest alone, right? And so the total, if you sum all this stuff up, that would be equal to the amount of interest expense for tax purposes on your loan. So you get a huge tax break in the early years because most of the mortgage, most of the payment is interest. Does that make sense to everybody? Okay. So much for question number 1. Question number 2. If you hold this mortgage for life, for 30 years, how much interest do you pay? What would interest expense be over the life of the mortgage? What does it cost you to borrow $100,000? Would be another way to ask that question, right? What does it cost you to borrow that money? How do you calculate that? Multiply what by what? 1029 times 360. I knew you knew that. I get 370,440. So now what? Subtract out the amount you borrowed and get 270,440. So roughly $270,000 is the amount of interest you'll pay over the life of that mortgage, providing it's at 12%. Does that make sense to everybody?
Is it the same thing as taking that all the way down to 30?
No. No, because if you take that all the way down to 30, what will the principal be at the end of year 30? Principal will be 0 at the end of year 30, right? So that would be a different calculation.
Aren't you asking in number 2? You said how much interest do you pay over the life of the mortgage?
Right. So if we sum up the second column, if we add this thing up for 30 years, that would be 270,440. Is that what you said?
Yes.
Is that what you meant?
Yes.
I'm sorry.
Okay.
I thought you said the right-hand column.
Oh,
Okay, so yeah, if you were to add up all the interest going down for all 30 periods, that would be equal to $270,000, give or take. Questions? Okay, last question. Last question is at the end of year 20, how much do you owe the bank? So at the end of year 20, and this frankly is probably the most important question in terms of present values that we're going to do. Understanding why this is true forces you to understand why present values are used to estimate value in economics. So at the end of year 20, how much do you owe the bank? Does that make sense, everybody? Okay, well, one way to do it is to do what? If you happen to have Excel, you create this table, right? And you just run this table down until what? You've gone through to period 240, you come over to the principal column, period 240, and voila, it's right there, right? That's the amount you owe the bank from your amortization table. And if you do this in Excel, that takes at least 3 seconds to do the whole thing, right? So it's not like it's a big deal. However, no one seems to have that calculation, so it must be a different way to do it. And the different way to do it is the most important part of what we're doing today. So, how do you calculate that amount without using an amortization table? Does that make sense?
Just take the annual payment 1029 for the 10 years that you have and get the present value of that.
Okay. That's exactly right. Here's the key insight. The key insight is initially, we're going from period 1 to period 360 at 1%. The annuity is 1029. And the present value of all that stuff is equal to what? The amount we borrowed, which was $100,000, right? Now, in terms of this timeline, the question is, what is the amount you owe the bank at the end of period 20? At the end of period 20, right, again, key, the amount you owe them at the beginning is the present value of the future cash flows, right? Or the present value of 1,029 for 360 periods at 1%. That's the amount at the beginning. The amount you owe them at the end of period 20 is still the present value of the future cash flows. So at the end of period 20, you'd have payments from 240 up to 360. So it would be the present value of an annuity of 1,029 for 120 periods at 1% per period. Does that make sense to everybody? So again, what's going on, if we go back to this table that we just created, this number right here, is the $100,000, is the present value of 1029 for 360 periods. 99971 is the present value for 359, 358, 357, right? And it's simply, so this column right here is simply a present value calculation. That's what this amortization table calculates. So in this case, who has the number for me? Anyone calculate that out? Oh, I don't know, you guys. Let me do all the work here.
Let's try 71,721, roughly.
That's about right. I knew it was about 71,000. Now think about that. So at the end of 20 years, you've already made payments for 20 years, you still owe more than 2/3 of the mortgage. So you have 1/3 of the mortgage to pay off in terms of time, yet you still owe 2/3 of the amount to the bank. And the reason for that is why? Because of the early payments, virtually all that is interest. Questions about that?
Yes. How can you figure out the factors without having the Excel spreadsheet in front of you, without having the present value table in front of you? Is there some sort of formula that you can put the interest rate into?
There is a future value of an annuity formula, a present value annuity formula. I don't have them off the top of my head, but if you look in the book, will have that on the tables. So you can use, now my recommendation is to not use that, to be honest with you. That is a pretty ugly thing to use in terms of the exponentials. But you certainly could. You know.
Well, I'm thinking about on the test. Like, I don't have a laptop and I don't have a calculator that gives me N and I and...
Anything on an exam you will be able to use the tables for.
Okay.
So if you have the tables, and you do have the tables, right?
Yeah.
For the exam, either midterm or final, you'll be able to use the tables to get any answers.
Okay.
Now, for the project, obviously, you're going to have to, the tables won't work, right, necessarily. Right. Okay. Next.
So what would be the moral of that story? Don't pay off for 20 years.
Just let it go to maturity, or...
Okay, so the question, what's the moral to the story? And the moral to the story is there is no moral to the story. Some people often ask me, well, should I pay it off early? Why do I want to pay all that interest? Should I pay it off early? And the answer to that is not so obvious. Because if you pay it off early, you have to pay it off with some money, right? You have to pay it off with cash. And the way to decide whether to pay off early is to ask the question, what is my rate of return on my assets that I'm investing, right? So I have the opportunity. If I have cash right now, I can either invest those assets at some rate of return, or else I can pay off the mortgage. Now, if the assets are going to earn a higher return by investing, than the cost of the mortgage, my argument has always been that you should invest at 14% rather than pay off a mortgage at 12%. Does that make sense? So I think that would be the moral to the story. Now, getting back to your question, my suggestion, right, is to get a calculator that does present values. $20, $30, get a very cheap, easy calculator that you can do this stuff. And here's my rationale. The first time I bought a house, this is 1973. I'm buying a house, and 1973 computers weren't all that prevalent. So I go to the settlement, and they present the papers in front of me, and they say, Mr. Boylan, your payment's going to be $359. And what did I do? I said, oh, wait a second. I'm sorry. When I did it, it's not $359, it's $329. So I think you're off by $30. And this lady said, oh, Mr. Boylan, the computer did it. We know it's right. And I said, well, you should go talk to your computer because it's wrong. And this was like a scene out of The Wizard of Oz. She trundled along behind the curtain. 5 minutes later, trundled back and says, oh, Mr. Boylan, we're so sorry. We're so sorry. You're right. Your mortgage is $329, not $359. Now, let's put that in perspective, right? That was a long time ago, and that was $30. $30 at the time was 3 cases of beer. So by being able to use a handheld calculator, I saved 3 cases of beer per month for life. Get yourself a calculator. The house I'm currently living in is a house up in farm country north of Troy, and a similar thing happens. I'm sitting at the settlement table, and my lawyer, who made up our settlement sheet, said, Bob, sign this thing. I did it. I know it's right. And I said, Ralph, I don't sign anything until I add it up. And so I'm going through and I'm adding up the settlement sheet, and there's one item, which is either a $2,000 or $3,000 item, which is money I should be receiving, but this turkey put it in the wrong column, which meant it was money I was paying as far as the settlement sheet was concerned. Now, a $3,000 item means a $6,000 change in cash, right? Because it's a zero-sum game. So by adding this thing up, taking an extra 5 minutes, I save $6,000. Second moral to the story? Get a calculator that does present values, okay, and can add, because I guarantee sooner or later it will save you some money. Okay.
Do mortgages usually go as a monthly interest rate?
Mortgages almost always are calculated monthly. That's right. So you want to be able to calculate that thing out and make sure what they're doing is right. Next thing. Suppose you're a company, and there's a machine out there that costs $190,000, and you're thinking about buying that machine. That's the cost. And what that machine will do is it will produce a cash flow stream for you, and that cash flow stream looks like this. $50,000 each year for 5 years. The opportunity cost your company requires, or the rate of return, is 12%. What's my question? Should you buy the machine? That's right. Should you buy this machine? How do you calculate that? How do you make that decision?
Is the present value of $50 or $50,000?
It's $50,000.
$50,000 over a period of 5 years at 12%.
So if we take the present value of the annuity of $50,000 for 5 periods at 12%,
Is that greater than?
and that would be the present value of the benefits from owning this machine, right, we would compare that to what? The present value of the cost. And if the benefits were greater than the cost, what would we do? We'd buy it. If the benefits were less than the cost, we'd not buy it. Right. So we do this present value calculation, and what's the present value? What's going to do all the work again, huh? I get 180,238 to 239. So, would you buy this machine? I got 180,239. Would you buy this machine?
No.
And the answer is no, because the present value of the benefits, 180, is less than the present value of the cost, which is 190. So if the cost outweighs the benefit, you wouldn't buy it. Question.
In like real world, you probably have a salvage value too, right? So you have to.
In the real world, you have a salvage value, but that would make the present value calculation a little bit more onerous. And we will model something like that using Excel next time. Right, but yes, it would have a salvage value usually. Okay. There's a thing called the net present value. And the net present value is equal to the present value of the benefit less the present value of the cost, which in this case is the 180, 239 minus 190. And that gives us negative 9761. So in this case, the net present value, or the NPV, and you will see NPV, I mean, the way virtually every firm in America values projects is by calculating a net present value. And so in this case, the net present value, which is the present value of the benefits at the firm's required rate of return, less the present value of the cost, gives it the net present value. In this case, net present value, negative 9761. If the NPV is positive, the firm should invest in that project. If the NPV is negative, the firm will reject that project and will not invest. Does that make sense to everybody? Now, so NPV is a very important part of today's class, because you're going to see that in finance, you're going to see that in strategy, you're going to see that in many, many classes from this point forward. Now, the next calculation we want to talk about is called the internal rate of return. And the internal rate of return is a situation where if we equate the present value of the benefits, set that equal to the present value of the cost, but we solve for the interest rate, that interest rate that equates the present value of the benefits to the present value of the cost is the internal rate of return. Now, our decision rule is, in this case, if our required rate of return is 12%, then if the internal rate of return is greater than 12%, what do? We buy the machine or we take on the project. If the internal rate of return is less than our hurdle rate, we reject the project. Right? Okay. So in this case, how would we figure out the internal rate of return? And the answer is, well, the present value of the benefits is what? The present value of an annuity of $50,000 for 5 periods at some interest rate, and that's the question, is equal to the cost. In this case, the cost is how much? $190,000. So if we are going to work through this, then what that would mean is that 50 times some number from the table. That's going to cost you $10. Now wait, yeah, what did we say? I forget. Buy beer? Okay, you got to buy beer. Oh, there's definitely a penalty to having a phone go off in my class. I got news for you. So beer's a much better idea than that. That's beer for the whole class. Like, not just me. You can't just bribe me on this one. You annoy everybody with that particular thing. Okay. If it happens again, then what happens? Then you buy dinner as well. Okay? Just so you know what's coming. Times some number from the table at 5 periods is equal to 190. Or 190 divided by 50 is equal to some number from the table. Right? Does that make sense to everybody? So then we look for the table and try to figure out what that internal rate of return is. So in this case, 190 divided by 50 is 3.8. Which table are we going to look at? Okay, so we're going to look at the present value of an annuity. Now, what's our guess as to what the internal rate of return is before we even go any further?
Worse than 12.
It's going to be less than 12%, right? Because we know we did not accept the project from our NPV calculation. So what we're going to do, if you would zero in on this thing, we're going to go down to 5 periods, right? And we're going to go over to 3.8, which is the number we calculated. So it's somewhere between 9 and 10%. Is that what we got? So our internal rate of return is somewhere between 9. So we go up to somewhere up here. We go to 9, 10%. So 3.8 would be somewhere between these two columns, be somewhere between 9 and 10%. So the internal rate of return on that project, and I'll calculate it using my calculator. 190 change sign is the present value. 50 is the payment. 5 is the periods. What's interest rate? A more accurate number is any day now. $9.91. That's 9.91%, which is what we got when we did the extrapolation, right? So using the calculator, 9.91%. We knew it was between 9 and 10%, closer to 10% based on the table. Good enough. Now, if you're doing a question like this on the exam and you're using the table, then if you just tell me make some estimate between 9 and 10%, 9.8, 9.7, something like that, good enough for the exam. Okay?
So basically what this means is you wanted to make 12% on your investment, but instead you're only making 9%.
That's exactly right. Okay. So all that means is that this return, the asset only return of 9%, we needed a 12, and so we don't want to do that. That's exactly right. Questions? Okay. So much for present values. Last topic for today, we'll start talking about ratios. So, Chapter 13, and I'm only going to spend maybe 15 minutes on ratios today, because I'm going to go through a few of these ratios, but what we're going to do in class on Tuesday next week is, if you look at Chapter 13, there's 2 cases. The first case is alchemy products. Let me bring that up on the screen for you. So, the first case, alchemy products, I'd like you to prepare. We're going to spend the first 10 or 15 minutes of class on Tuesday talking about alchemy products. Similarly, now this is a very short case, and in fact I do much of the work for you. The second case is the case of the unidentified industries. And what I do in this case is I give you the ratios for a series of 5 different industries, and your job is to figure out which industry is which. Your 5 alternatives are, it's either electric utility, Japanese trading, retail jewelry, automotive manufacturer, or supermarket chain. So these 5 are listed here, A through E, and you have to figure out which one's which. We will be doing that in class on Tuesday. That's what we'll start with. So please prepare those things and be prepared, because I certainly will not do this for you. I'll be asking people in class to give me their opinions. Questions? Okay. First 2 pages. So in this thing I am talking about financial ratios, just so you know where I am. Chapter 13, financial ratios. I just want to go through very quickly and review some of the financial ratios. Now, I'm not going to force you to read it off this list. I'm going to write some stuff down so I know where I am. Okay. Ratio number 1, the current ratio. And the current ratio, very simple. Current assets divided by current liabilities. Now, what are current assets again? What's the definition of current assets from that classified balance sheet we looked at earlier in class today?
Property, plant, and equipment.
Okay, is property, plant, and equipment part of current assets? No, that's long term. Anything we expect to turn into cash within the next 1 year. So receivables, inventory, things like that. Current liabilities, anything we owe within 1 year. Now, from the health of a firm's perspective, higher is better, true or false? True. Higher is better, true or false?
Depends on the industry average, but higher is better. It just depends on the average.
No, it depends what you want.
In general, on average, higher is better, true or false?
True.
Probably true, right? However, suppose this number gets too high.
Well, if the assets is cash, then that means you're not doing a good thing by keeping a lot of cash when you could be doing something else.
Exactly. If your current ratio is extremely high, that means you have a very large amount of non-productive assets. You may have a lot of cash. You may have a lot of inventory or a lot of receivables. Those are not productive assets. So, I mean, in general, higher is better, right? You have more liquidity if current assets are higher, and that's certainly reasonable. But if this number gets too high, then it could be that you are not efficiently using assets. Okay, the quick ratio. The quick ratio is, now it's basically current assets less inventory divided by current liabilities. Higher is better, true or false? In general, on average.
Yes.
The answer is yes. In general, higher is better, right? But again, if it gets too high, it could be problematic because maybe they have too much in cash. If you have a whole lot of cash hanging around with nothing to do with it, you're a prime takeover candidate.
If it's too low, wouldn't you say you have too much inventory?
If what's too low?
That ratio?
Well, if the first one's too high and the second one's too low, then you certainly think you have too much inventory. That's exactly right. The reason we have the quick ratio in addition to the current ratio is because we're trying to isolate out the effects of inventory, right? In other words, current assets other than inventory are the assets that are going to turn into cash in the very short period. Receivables, cash, marketable securities, they very quickly convert into cash, and so it's a more liquid measure of how quickly the firm can generate cash.
You said if something like the quick ratio is too high, you have something for table?
I said if the current ratio is extremely high, and the reason is that there's a whole lot of cash, or the quick ratio is really high because the firm has a whole lot of cash hanging around, then all of a sudden they can become a takeover target. In other words, a firm can look at that, and if they buy the firm, they get all that cash to use. So, I mean, for instance, if you look at MapInfo, which is a firm that works out of Troy, more or less, at one point they had a public offering of stock, and they raised just $1 gazillion. And then as soon as they did that, they realized they didn't have the investments they thought they had, so they were sitting on a boatload of cash for a long time. And so, you know, they had fairly unproductive assets. They didn't know what to do with the cash, and we're a primary takeover candidate for quite a while. I mean, for instance. Does that make sense? Okay. Leverage ratios.
Why is that bad?
Why is what bad? Leverage ratios?
Being a takeover candidate.
Well, it's neither good nor bad, right? But if it were your firm and the managers at your firm were inefficiently using your assets, would you be happy? No. So, in that sense, it's not very good, right?
So how did they turn that around?
How did they turn around? They didn't.
They're still on the cash?
Yeah. To the best of my knowledge. I can't remember if they've been taken over or not. But when you look at their balance sheet, it's just staggering how much. So if you look at it over the past 6 or 7 years, it's staggering how much cash they have hanging around. Now, a firm like Microsoft has a similar problem. In the sense that has a whole lot of cash, doesn't know what to do with it. So they go out and buy companies, right? But they had such a huge cash position, no one could take them over because they were bigger than anybody else. They were the biggest gorilla in the jungle. But their problem was simply they didn't know what to invest in because they just had so much cash. All right, leverage ratios. First question: what is leverage? What is meant by leverage?
The ability to influence others with your status.
Not social leverage, financial leverage. What is financial leverage?
It's basically like you can leverage an account like 10 to 1. So basically, I think like if you have, I'm trying to say this. If you were at $1,000, you could borrow up to $10,000. Unleveraged. Well, I guess that would be more like margin, but if you were leveraged.
Margin is leverage, in essence. Right. Okay. Leverage is very simple. It's the amount that you borrow, the percent borrowed. Let's take, I know we have different measures of leverage, but let's take a very simple example. What's the accounting equation again? Assets equal liabilities plus equity, right? Now, let's say we have $100 million in assets, and therefore we split it between liabilities and equity, right? Let's say we have, of the $100 million that we raised in assets, we borrowed $40 million, and therefore how much did we raise through equity and or through retaining earnings? 60. Now, one measure of leverage is what's the percent of our assets that are financed through debt? So in this case, what's the percent of our assets financed through debt? 40%. So in this case, what's called the debt ratio. And the debt ratio is simply liabilities divided by assets. In this case, it's 40 over 100, or 40%. Questions about that? Now, if this firm had a higher amount of leverage, what would happen to this percent? It'd go up, right? So in other words, if we change these numbers to 55 and 45, right, then this number becomes what? 55%. And therefore, the firm with 55% is more highly leveraged, right? It has more debt than the firm that had a debt ratio of 40%. Does that make sense, everybody? Now, which of these two firms has a higher financial risk factor? The financial leverage at 40% or the financial leverage at 55%? Which is riskier to an investor? The 55% firm is riskier. Why? Where does risk come from? Does the amount of debt indicate the amount of risk? And the answer is no.
Could you make the argument that if you wanted to provide them with more leverage, you have you believe you have a better chance of getting that money back?
You could present a lot of arguments, but the risk will still be higher. The rate of return might well be higher, right? But the risk would be higher with higher leverage. Okay? So it might be worth taking on extra risk because you're compensated by a higher return, which I think is the argument that you're making. But the risk itself will clearly be higher. But now the question is why? What is risky about debt?
It's just compared to how much you have to back it up, the assets. It's not how much you owe, but if you have a lot to back it up, then...
Well, in this case, we're talking about in terms of percents, right? So why is 55% higher than 40% in terms of risk? I mean, I kind of agree with what you're saying, but you're not hitting the roof.
It means you don't have as many assets proportionally wise to stand behind it.
Wouldn't liquidity be? Liquidity?
Okay, it has to do with liquidity. What does that mean? It has to do with liquidity, I agree.
How fast you can convert.
Because if you get the money that you owe, if something should happen, you need to pay it back quickly when you're going to have to turn to your assets.
Okay. Why is higher debt riskier? That's the question. Right? So the first thing you have to ask yourself is, how does the market measure risk? So that's the first thing we need to talk about. In order to talk about risk at all, the first thing we have to talk about is how does the market, how does the street measure risk? So how does the street measure risk? And the answer is variability of earnings. So the way the street measures risk is variability of earnings. For instance, this is time, and this is earnings. Suppose one firm has earnings that swing like this, and the average is, say, $2. We're talking in terms of dollars here. And a second firm has the same swings, right? But the swings are lower. Which firm is perceived as having lower risk? Firm B or firm A? And the answer is A has higher risk. Everyone agree with that? Question so far. Now let's go back to the original question, which is, why does the firm that has a higher amount of debt have higher risk?
They might be more likely to default on a debt, on a loan.
Okay, one reason is because there's a certain amount of default risk. I agree with that, right? But let's talk more about the impact on earnings. I mean, you're exactly right. That's part of the equation. Default risk is certainly part of the equation. But let's just talk about the impact on earnings that higher amount of debt has. Does that make sense, everybody? Let's look at an income statement. If we look at earnings before interest and taxes, or what's called Ebit. Everyone with me so far? Say that again. Earnings before interest and taxes. And this is one of the called line items that gets regularly used anytime you analyze a company. What is their Ebit? So Ebit here, and let's say this is a 40% company, this is a 55% company. Now, the Ebit here says earnings before interest and taxes, subtract out interest, right? Now let's not worry about what the number is here. What happens to the amount of interest for the 40% company compared to the interest for the 55% company? Which has higher amount of interest expense? 55 has higher interest expense, right? So if interest expense is going to be higher, what's kind of net income? It may well be lower. Does that make sense to everybody? Now, more specifically, right, is the fact that with 55%, the reason it's more risky is because the firm has to pay interest payments every year on that debt. And the interest payments every year, because of the legal contract, have to get paid. And so the cash outflow every year to make payments on that interest affects their net income, which then affects their earnings per share. Does that make sense to everybody? And so the reason having a higher amount of debt is more risky is because the payments you have to make every year is going to be higher, which then has an effect on earnings, which then affects earnings variability. Does that make sense to everybody? Okay. Now, leverage ratios. There are the first ratio we talked about, which is the debt to total assets. It's called the debt ratio. The next one is, which will be the fourth one down, the times interest earned ratio. Times interest earned ratio, which is net income plus interest plus taxes divided by interest. Now, higher is better, true or false?
True.
This is called what's times interest earned. That's net income plus interest plus taxes divided by interest. Higher is better, true or false?
True.
True. Right? You go back to our net income plus interest plus taxes is equal to what? Earnings before interest and taxes, less interest gives you earnings before taxes, less taxes gives you net income. Right? So you take net income, you add back taxes, you add back interest, what do you get? You get Ebit. Right? You get earnings before interest and taxes. So another way to say this here is Ebit divided by interest. So what does this measure? It measures what earnings do you have to be able to pay your interest expense in that period. Right? Higher is better, true or false? The answer is true. Questions about that? Okay, spend a couple minutes on activity ratios and then let's end this part. Activity ratios. So I'm at the bottom of the page. Accounts receivable turnover. So accounts receivable turnover is credit sales divided by accounts receivable. Higher is better, true or false?
True.
Don't answer that. If a firm has typical credit terms, what would you expect their accounts receivable turnover to be?
12.
About 12, right? Average credit terms are what? 210 net 30. If every firm takes 30 days to pay on average, then that would mean that the average turnover would be once a month, right? So it would be 12. Right? That makes sense? Higher is better, true or false?
True.
And the answer is tough to tell, right? Because if that ratio is really high, that means you have very, very stringent credit terms. And it might be better for the firm to liberalize their credit terms and therefore get more in sales that could conceivably increase profits. Does that make sense, everybody? So, like most ratios, there's some reasonable range where Going too high is not good. Being too low, probably not good either. Does that make sense, everybody? Okay. Next one, let's look at. Let's look at inventory turn. Inventory turn is what? Is cost of goods sold divided by inventory. Usually average inventory, beginning and ending. Same with average accounts receivable. But cost of goods sold divided by higher is better, true or false?
True.
And the answer is probably true, right? Because the way to get this thing higher is to do what? It's either sell more, in which case cost of goods sold goes up, or to have less inventory, right? Which means you have less invested in inventory, which means you're being more profitable. Does that make sense, everybody? Now, okay?
Is that cost of goods sold over a certain time period?
For the year. Right. The number that GE has been looking for is what? Just to pick a number, just to pick a firm that happens to hang around in town. They've been looking for 10 for quite a while. Right? So, questions? Had enough accounting for today? Okay, so you can work through the rest of these ratios. And in class, we will start with alchemy products and the case of unidentified industries on Tuesday. You all have a great week. See you next week.